This is another great moment. We meet again a student for a session of advanced, that is financial reporting and analysis, and not advanced financial reporting. For now, we are doing financial reporting and analysis, the one in intermediate level. So for today's session, we are going to do International Accounting Standard 7. That is on how organizations prepare their cash flow statements. So cash flow statements are prepared to show the sources of funds and application of funds for an entity. The sources and application of funds for an entity. So the sources of funds can be from 3 areas, that is operating activities, investing activities, and financing. So for the operating activities, these are based on the cash from day-to-day operations. So it involves the daily operations. For investing, we will be considering either what you receive from disposal of an asset or what you paid to acquire an asset. For financing activities, we have to consider how the organization is financed generally. It can be through issue of shares or borrowing of funds. Then now to wind up the introduction, you know that when presenting cash flow statements, you can use either direct method or indirect method. So there's some notes here which are in terms of a soft copy. I think you have them. So definition, you consider I started by explaining the term cash. It consists of cash in hand, cash deposits. That is all about cash in hand and deposits payable upon demand. Rest overdraft. This includes cash held in foreign currency. So cash equivalent are a short-term, highly liquid investments that are readily convertible to known amount of cash and are subject to an insignificant risk of change in value. So cash flows are inflows and outflows of cash and the cash equivalent. So that's why I'm saying that generally when I will be preparing cash flow statements, what does a cash flow statement show? In a nutshell, the sources and application of funds. In a nutshell. So classification of cash flows. So I7 does not prescribe a specific format for statement of cash flows, although it requires that cash flows are classified under 3 headings. That is cash flow from operating activities. We have cash flow from investing activities, and we have cash flow from financing activities. So the cash flow from operating activities, that is defined as the entity's principal revenue earnings activities and other activities that do not fall under the next 2 headings. So operating activities, the cash flow from operating activities defines as the entity's principal revenue earnings. So I said in short, it involves cash flow based on the daily operations of the entity. And they have said that it is defined as the entity's principal revenue earning. Then we have cash flows from investing, defined as the acquisition and disposal of long-term assets and other investments, excluding cash equivalents. So when I will be talking about investment again, in a nutshell, I will be covering the aspect of if an asset is acquired, if an asset is disposed, if an asset is acquired, or if an asset is disposed. If an asset is acquired or is disposed. So if you acquire an asset, remember that you pay cash. If you dispose, you receive cash. You receive cash. Then we have cash flows from financing. So cash flow from financing, again, to just explain for your understanding, I will be checking if we received funds from borrowings, or from some of them is from issue of shares. So how was the entity financed? Was it through issue of shares or was it through borrowings? So that is why now I said here that defines as activities that change the size and the composition of the entity's equity and the borrowings. Entity's equity and the borrowings. So we have a pro forma statement for cash flow as per I7. I used the dollars because this note I was using to teach some students in SCCA. So never worry about the dollars you see there. Never worry about the dollars you see there. So assume that now it's Kenyan shillings. So this is a format of a cash flow statement, a format of cash flow statement. But when I will be doing again a question, I will be able to interpret it more. So we always start from profit before tax. We always start from profit before tax. So to make it a bit simpler for you guys, when I will be talking about this cash flow statement, a format of it, I will start from profit before tax. The profit before tax, remember that you will be given in an income statement. It will be provided in an income statement. Then we talk about adjustments to be done against this profit before tax. So the adjustments to be done against this profit before tax. So remember that there's some adjustments. There's some adjustments which were adjusted in order to get the profit before tax. An example of incomes and expenses which can be adjusted to get the profit before tax are, which are some of the expenses, you know, which can be deducted to arrive at the profit before tax, or which are some of the incomes, of which I can assume that you know. Things like investment income was added, things like maybe if there was a gain from an associate or a joint venture, if the parent had invested in associate or joint venture, that is another income. And we can check on the aspect of expenses like depreciation, impairment, loss on disposal. So those ones, you will find that in order to get this profit before tax, those items were done what? Were adjusted up here. In our income statement, students, you know that we start from revenue. Please mute your mic, whoever who is unmuted, if there's no question. Kasim. Kasim, good morning. So that is fine if you have muted your mic. So if you don't have any question, please remain muted. But if you have a question, you can just interrupt the session, you ask, I would answer, we continue. So under income statement, you know that we start from revenue. We raise what? Cost of sales. Cost of sales. We get gross profit. We add some incomes. And we raise some expenses. So we have some incomes and expenses which were adjusted to get this profit before tax. And some of those expenses are non-operating. And some are operating. So the one which are non-operating are the one which I adjust against my profit before tax. Which are these expenses? We have depreciation. Depreciation is even an non-cash outflow. So that one you adjust, you add back because it was an expense. It was deducted. Impairment, you add back. We have amortization. We have loss on disposal. So if it was a gain on disposal, this one you subtract because it was added. We have finance cost. Finance cost you add. Then we have investment income. This one it was added, we subtract. Then we can have it again. I can say not again, but I can say share of profit after tax in associate or joint venture. Share of profit after tax in associate or joint venture. Share of profit after tax in associate or joint venture. share of profit after tax in associate or joint venture. So up to that point, you get cash flow. I will write in short, cash flow before changes in working capital. Before the changes in working capital. Then you will come and talk about changes in working capital. Changes in working capital. So for the changes in working capital, I will consider current assets and current liabilities, increase or decrease. Under current assets, I will consider inventory and receivables. Under the liabilities, I will consider the payables. So under the current assets, I have said I will consider what and what? Inventories and receivables. Increase or decrease. So increase in current assets, increase in current assets, and a decrease in current assets, decrease in current assets. So increase in current assets. Now from this point, I will be considering from the perspective of either cash inflows or cash outflows. So for the increase in current assets, when your asset increases, it means that there is cash outflow. You have paid money to buy stock. Decrease in current assets. Decrease in current assets means that you have sold your stock of your, or you have sold, yes, your stock. So you have money, you have received cash. Then you will come and check current liabilities, increase or decrease. Increase or decrease. So increase in current liabilities, and we have decrease. Decrease in current liabilities. So increase in current liabilities, you add, decrease, you subtract. Because decrease in liabilities, you have paid your liabilities. Increase in liabilities, you have acquired, like now, loans, this money in, you add. So up to that point, we have a cash generated from operations. Cash generated from operations. Cash generated from operations. Cash generated from operations. We have the cash generated from operations. So after considering the cash generated from operations, and we raise the tax paid, whereby under tax, we have to consider both current tax and deferred tax. So we have to consider current tax and deferred tax. We have to consider the current tax. So you will come and say raise tax. Raise the tax paid. So the tax paid, this one, two columns here. So deducting the tax paid, you can be able to get cash flow now from operating activities. Cash flow from operating activities. So the cash flow from operating activities. So in short, under operating activities, and this is an indirect method I'm talking about. That is what I never clarified. This is the indirect method. So under operating activities, when you are doing your indirect method under operating activities, this is what is supposed to be done. You start from your profit before tax. You adjust your profit before tax against the non-operating items, which are incomes and expenses, which were adjusted to get this profit before tax. So which are these items? Depreciation, impairment, amortization, loss on disposal, gain on disposal, finance cost and investment income. And finally, we have the share of profit after tax in associate or joint venture. Things like depreciation, these were expenses. To arrive at the profit before tax, they could have been deducted. We add back. The same thing with impairment. Impairment is an expense. You know that for you to have impairment, you must have goodwill. So goodwill is impaired. But now here we don't have to go ahead and do a lot of computations of the goodwills, you know, from consolidation. No. On this scenario, we are just doing analysis. We are just doing analysis. So we talk about depreciation, impairment, amortization. What is amortized? Other intangible assets, other than goodwill. Things like patents, trademarks, copyrights, they are amortized. Then we have loss on disposal. Remember that if you disposed an asset, you got a loss, that is an expense, you add back. Because in order to get profit before tax, it could have been deducted. Now we are adjusting against that profit before tax. Again, on disposal, it could have added, we subtract. Finance cost, you can see it could have been deducted, we add. Investment income, it could have been added because to get profit before tax, investment income is an income. So obviously it could have been added. Now we are adjusting against the profit before tax, we deduct. The same with share profit after tax in associate or joint venture. Remember that if the parent had invested in a joint venture or an associate, he always receives income. So that is what we call share of profit after tax in associate or joint venture. So that income he receives is obvious recorded in the income statement as incomes. So which means that it could have been added. It could have been added. So which means that here we do what? We subtract. Here we subtract. So what is supposed to be done there is subtraction. Then we have the cash flow before the changes in working capital. So the one I've written in short, cash flow before changes in working capital. Then after that, we talk about changes in working capital. So the changes in working capital is all about increase in current assets, current liabilities, or the same decrease in current assets or decrease in current liabilities. Current assets, I have said that students, you consider inventory and receivables. Under liabilities, you consider payables. Then up to that point, you get cash generated from operations. After that, now we rest tax paid, we get the cash flow from operating activities. Before I continue to investing activities, is there any question? Is there any question? So if there's no question, we can continue. I explain the other part. So investing, and I kindly follow my format because it's simplified. So investing activities, we consider assets which are acquired or disposed. Assets which are acquired or disposed. So if there was an asset which was acquired, you paid cash. But before I talk about cash paid to acquire an asset, remember that if you disposed an asset again, you received the cash. So let me start with the cash you received. Cash received on disposal. Cash received on disposal of asset. Cash received on disposal of asset. We have cash paid to acquire asset. Cash paid to acquire asset. Then after this, we talk about investment income. We talk about investment income. After talking about investment income, we have to talk about dividend received. Dividend received from associate or joint venture. Associate or joint venture. So up to that point, we have cash flow from investing activities. I said the first one was operating. So this is investing. Then we go to financing activities. Go to the financing activities. So for the financing activities, so I said that what we are supposed to consider is just how the organization was financed through either issue of shares or borrowing. So if there was issue of shares, we received the cash. Cash received on issue of shares. Cash received on issue of shares. Cash received on issue of shares. We have cash paid on the redemption of shares. So if you did a redemption is to buy back. Cash paid on redemption of shares. So cash paid on redemption of shares. Then we have dividends paid by the parent. Dividends paid by the parent and dividends paid by, not by, to NCI. So there's dividends paid by parent and the dividends paid to NCI. Dividends paid by parent and the dividends paid to NCI. Dividends paid by the parent and the one paid to NCI. And after that, we consider either loan repayment, loan stroke risk repayment, loan stroke risk repayment, or we can have even acquisition of loans. So if you acquired loans. So you can see I have considered that items. Like now, if you issued shares, you received cash. If you redeemed shares, redeeming shares is buying back of your shares. You paid cash. If you paid dividends to NCI, that is done by the parent. So dividends paid by parent, you deduct. Dividend paid to NCI, you deduct. You made a loan repayment, you deduct. You acquired another loan, so that is money coming in, you add. Up to that point, guys, I can say that we are done with financing. So you say cash flow from financing activities. Cash flow from financing activities. So cash flow from financing. So the answer you have from your operating, the answer you have from your investing, and the one we have from financing, we add them so that we get net cash flow. So net cash flow is your answer from, so this is B, this is C, and our A was this one. So you take A plus B plus C, A plus C. So operating, investing, and financing, A plus B plus C. Then after doing that, you say add cash and cash equivalent brought down, cash and cash equivalent, cash and cash equivalent, balance brought down, so that we have at the end, cash and cash equivalent carried down. Cash and cash equivalent, balance carried down. Cash and cash equivalent, balance carried down. So this is how you are supposed to do your cash flow statement using the indirect method. So that is the format to be followed. Any question again? Abdul, Delvin, Leah, Ririan, Quinta, any question? Any question?
No question.
So you're okay. So what I have to do is now to talk about direct method. So the only different part of this statement between direct and indirect is only the operating activities. It's only the operating activities. The only part which will not be the same is only the operating activities. The others would be the same. Investing and financing activities are the same in both methods. That is why I will just go through this. So direct method, when we talk about operating activities under the direct method. So direct method shows cash receipts and payment. This includes cash receipts from customers, cash payment to suppliers, and the payment to and on behalf of employees. So the examiner has indicated that the direct method is unlikely to be examined in detail, although you may be required to explain key similarities and the differences between the two methods. So the indirect method used in the pro forma statement, the one we have just written down, the one I have just interpreted, starts with profit before tax and adjust it for non-cash charges and credits, deferrals, or accruals of any past or future operating cash receipts and the payments, as well as the items that relate to investing and financing activities. So the most frequent recurring adjustments required are, so we have talked about them. I don't want to repeat myself, So I would like to draw that small format of a direct. The only part is that part of operating activities, which involves cash received from customers, cash paid to suppliers, and the cash paid to employees. For the investing and financing, they are the same in both methods. That is both direct and indirect method. Investing and financing activities are the same. Direct method, and that is the only part of I will be talking operating activities only. I will be talking about operating activities. So for the operating activities, we start from cash received from customers. Cash received from customers. Then we talk about cash paid to suppliers. Then we have cash paid to employees. So up to that point, you get cash generated from operations. Cash generated from operations. So rest, tax paid. So resting the tax paid, you get cash flow. Cash flow from operating activities. Cash flow from operating activities. So I said for investing and financing activities, you do the same way I did for the indirect method. So, but now how can you get cash received from customers? What can I prepare, guys? I do what? Debtors account. So I will do this debtors account in a question. Then what about cash paid to suppliers? So the first thing you do is you determine credit purchases. You determine credit purchases first. After determining your credit purchases, you prepare which account? Creditors account, which is a payables account. You prepare the payables account. You prepare the payables account, which is the creditors account. Then for the employees, what employees are supposed to be paid, you consider your expenses, your operating expenses. You consider your operating expenses. So that is, I would be considering admin expenses, and I will consider my distribution. So those two. And making any relevant adjustment to those admin and distribution. To those admin and the distribution. So that is a short introduction. That is a short introduction to this topic of International Accounting Standard 7, preparation of cash flow statement, the preparation of cash flow statement, the preparation of cash flow statements. So, students, to make this question to be of value to you, or you understand more, obviously we would like to make an illustration from our past papers. That is May 2014, a question of May 2014, a question in that sitting of May 2014. I think you have the past papers. That is May 2014, question 4. May 2014, question 4. So May 2014, question 4. And at the same time, I will display that question from my end so that it will be able to answer now what I have been explaining from the introduction part. So this is the relevant question I'm talking about. This is the relevant question I'm talking about. The consolidated income statement of Uongozi Limited for the year ended 30th September 2013, together with the comparative consolidated statement of financial position as at 30th September 2013 and 2012 are shown below. So we have income statement for the year ended 30th September 2013. Then we have a statement of financial position here for the year ending 30th September 2013, 30th September 2012. Then we have additional information, students. We have additional information whereby you are told that the cost of sales included depreciation of property, plant, and equipment amounting to 640, and a loss on sale of plant of shillings 100,000. Intangible assets are stated at the book value and complies goodwill and others and other intangible assets. So going back to your non-current assets, just to go back to your non-current assets under the statement of financial position. Checking on my non-current assets, I can see that the intangible assets, the figure which are here is 13 and 600. The 13 and the 600. So going down to my additional information number 2, you can see it's just that they have said what it was making up the 1300 and the 600. It's goodwill and other intangible assets. Other intangible assets acquired during the year ended 30th September 2013 amounted to shillings 1,000. The cost of the intangible assets is included in the above analysis. Number 3, during the year ended 30th September 2013, during the year ended 30th September 2013, holding company acquired a new plant which cost shillings 500 million. The company also revalued its building by 400. On 1st October 2012, the holding company made a bonus issue of 1 share for every 10 shares held. The issue was financed from the revaluation reserve. The detailed analysis of the retained profit as at 30 September 2013-2012 was as follows. Balance brought forward You are given there, profit for the year, transfer to revaluation. That is wrong. Cash name did a mistake here. It's from. There's no way you can say there's analysis of this retained earnings, there's analysis of the retained profit, then they give you a transfer to, then they add. If it's a transfer to, it's supposed to be deducted, because now it's being transferred to revaluation. So it's supposed to be a deduction. So since they made that mistake, we have to correct and say that this is a transfer from, because they added that 20. This 20 was coming from the revaluation reserve. It's a transfer from, but it's just a minor mistake. So dividends declared and paid. So balance carried forward, balance carried forward. So what does the examiner need from the students? So group statement of cash flow for the year ended 30 September 2013 in conformity with the International Accounting Standard 7, statement of cash flows, statement of cash flow. So they are not very specific which method are you supposed to use. But for the benefit to you guys, I would use both methods, indirect and direct. But I encourage that during your exam, if they are not specific, just go for the indirect. You will earn more marks under the part of operating before even you continue with the other two parts, that is investing and financing activities. So you will give me 1 minute. I do something here, then we continue now with the computation. Now the presentation, it was a question of uongozi. It was a question of uongozi limited. So that is a consolidated cash flow statement. So that is for the year. So our financial year was ending when? It is for the year ended. Our question is for the year ended 30 September 2013. 30 September 2013. So where am I supposed to start from? I'm using the indirect method. Where am I supposed to start from, students? Delvin, where am I supposed to start from?
Profit before tax.
Profit before tax. Our profit before tax is? You have the question, Delvin?
I'm trying to open mine.
So the profit before tax is here in this income statement of ours. It's under page 45 of the laptop you are using. If you are opening in your laptop, you can just go to page 45. So profit before tax is 1740. Profit before tax is 1740. That is what you start with. Then we adjust. So we say adjustments for. So adjustments for. So what am I going to adjust against the 1740? If there is depreciation, if there is depreciation. So these are the items you just write before even I check if they are present or not. Depreciation, impairment, amortization, Loss on disposal. And we have gain on disposal. Gain on disposal. So these ones you write before even you check if they are present or not. And that is the only way you can do this cash flow in an easier way. Up to that point, these are the adjustments you just write before you check if they're present or not. Let's go and check if they are present. Depreciation, was it there? Was there depreciation? You go to additional information. Additional information number 1, the cost of sales include depreciation of property, plant, and equipment amounting to 640. That is what you record here. That is the 640. Impairment and amortization. What is impaired? Goodwill. You need to check goodwill. Then you analyze from the year 2012 to 2013. Is there a decrease or an increase? Remember that what you are provided here is this, the year. We have the year 2013, September, and the year 2012. So what they mean when they have provided you with the 2 years, we have 30th September 2013, and we have 30th September 2012. So the one for 2012, remember that the balances for 2012 will be my opening here, because this year will be starting on 1st October 2012. So which means that the balances from this previous year will be the opening here. So the one at the end of the previous year is the balances I will be calling balance brought down. Then the one at the end here are the balances carried down. Then you are given transactions during the year. So you have to consider your balance brought down. You adjust what happened during the year. Then you compare with what you have at the end. Then you make a final conclusion. You make a conclusion. So let's check if there is impairment. For impairment to be present, you have to be given goodwill, of which they analyzed in note 2 that the intangible assets, which was under the non-current assets, was made up of goodwill and other intangible assets. Other intangible assets. So it reduced from 400 to 360. Remember that this is the balance brought down, and this is the balance is carried down. As I have interpreted those dates. So there's a reduction of, so which means that there's an impairment. 400 minus 360, that is 40. Then amortization. Is there another intangible asset? Yes, there was other intangible assets in the same addition information number 2. There's this balance brought forward, this of 200. Then other intangible assets acquired during the year. So before I compare my 200 with 940 at the end, I have to add this other intangible asset which was acquired to 200. So we have 200 plus 1,000, 200 plus 1,000, that is 1,200. But at the end is what amount? 940. So there's a reduction of 1,200 minus 1,200 minus 940. Do you have calculators?
260.
So we have 260. So that is an amortization. Then loss on disposal, gain on disposal. It's a loss on disposal, not 1 over 100. That is what they say. That there was a loss on disposal of 100. That is additional information number 1. Loss on disposal on the sale of plant and machinery. Not plant and machinery, but just plant. 100 there. Is there anything which was sold for them to get again? Nothing. So up to this point, this one is, there's nothing here. Then after that, after you have recorded the 5 items, you go back to your profit before tax. You go back to your profit before tax. You go upwards this way. Other than revenue, cost of sales, admin, and distribution. So let me go to that income statement so that I mark the operating items. The others which are remaining is non-operating. You adjust against your profit before tax. You adjust against your profit before tax. You adjust against your profit before tax. So we have sales. Other than sales, cost of sales, that is operating, and operating expenses. Operating expenses are made up of which expense and which expense? Admin and distribution. Admin and distribution. So admin, administration, and selling and distribution. So other than the three, another item which is above this profit before tax, you adjust. And the only one which is above there is finance cost. So the finance cost is 60. It was deducted. We add. So up to that point, we have cash flow before changes in working capital. So 1740 plus 640 plus 40 plus 260 plus 100 plus 60. Are you getting 2840? Unapata hiyo? That is okay. Then changes in working capital. The changes in working capital. So for the changes in working capital, you check current assets or current liabilities. Current assets or current liabilities. So for the current assets, we talked about inventory and receivables. Increase, decrease. Increase, decrease. What about inventory there? Is it an increase or a decrease? You compare from 2012 to 2013. So balance pro down towards the end. It increased from 1880 to what? 2840. So 2840 minus 1880. What do you have? Give me the figure for that. Even the receivable increased from 1980 to, not 1980, from 1360 to 1980. So there was an increase. You compare from the start towards the end. So from 1880 to 2840. So the increase is 2840 minus 1880. 960. Increase in inventory, cash out. This cash out. 1980 minus 1360. 620. Again, cash out, because now your debtors are increasing. You are giving them more money. The same way your stock is increasing, you are paying money to buy stock. So what about payables? What about in payables? You go to the current liabilities, increase, decrease, increase. So increase in payables. So the increase in payables, that is 1750, 1460. So from 1460 to 1750, the increase there is 1750 minus 1460, 290. So we have the increase 290. So up to that point, we have cash generated. Cash generated from operations. So cash generated from operations. So 2840 minus 960 minus 620 plus 290. So I'm getting 1550. I'm getting 1550. Then next we raise what? Tax paid. We raise the tax paid. So for the tax, so let us check the current and the deferred tax. So the current and defined. So under liabilities, under long-term and short-term liabilities. Under the long-term liabilities, under the long-term, we have deferred tax and we have the current tax. So you compare by combining first. You combine that as your balance brought down, and then this is the balance carried down. These are the balances carried down. But before that, there's transactions which might occur during this year. During that period, there's some transactions which might have occurred. So for the tax, so current tax and deferred tax. So we have balance brought down. 2080 plus 320. 2080 plus 280, that is 280 plus 320. Those are the current and deferred. 600. Go to the income statement. Add the income tax which was supposed to be paid for the year. The income tax from the income statement, the one which is supposed to be paid. The one which is supposed to be paid during the year. So the income tax which was supposed to be paid during the year, it's down here. There's a page which is skipped here. There's no information there anyway. So the income tax is 540. That is for the year. That is for the year. So it's all about brought down, current, deferred. You add income tax for the year, the one which was supposed to be paid for that year. So the total tax Uongozi was supposed to be pay is 1140. But now at the end, the tax which is told to pay is of which amount? The tax which is supposed to pay is of which amount? Is of which amount? You combine deferred tax, 620, current tax, 260. So 620 plus 260. 620 plus 260. That is deferred tax plus the current tax. So that is 880. 880. So 1140 was the tax which was supposed to be paid, but at the end of the year, they are supposed to pay 880. Uongozi is told to pay 880. Why this reducing now from 1140 to 880? Because already has paid 260. Tax paid. He has paid 260. So that is what I deduct here. So that 1550 minus the answer is, that is 1290. That is the 1290. So that is cash flow from operating activities. Cash flow from operating activities. So we have the cash flow from operating activities. So we talk about investing activities. So for the investing activities, we talk about what you received from the disposal of assets, cash received on disposal of assets, cash paid to acquire assets. We have to talk about, so let's talk about the first two, then I will be able to interpret the others. So cash received. So which was the cash received? Which was the cash received? So cash received. Remember that in addition information number one, in the addition information number one, so I was creating whereby we can do workings. So we have to do working. So I was saying that in the addition information number one, what they said is this. In the addition information number one, what they said is that the cost of sales include depreciation of property, plant, and equipment amounting to 640, and the loss on disposal of plant of 100. That is a loss they made when they sold an asset at what value. So we need to look for the amount at which an asset was sold, so that they made up a loss of 100. So I have to do PP analysis. I want to do my property, plant, and equipment analysis. So the balance brought down. The balance brought down. The balance brought down here is, so that is 3660. You remember that 2012, the balances as of 2012 are the one which are opening for the year, starting 1st October 2012, which is ending 30th September 2013. So in short, my balances brought down are the one for 2012. The balances brought down for the year of 2013. You understand that interpretation I did for those dates. When our financial year is ending, when it's starting, that way. You remember, I think. So my balance brought down for these PPE, property, plant, and equipment is 3660. That is what I record first. Then I will check what is affecting my PPE, anything else which can affect property, plant, and equipment. So you go to additional information. You start from additional information number one. The first thing which will affect your PPE is depreciation. Remember, depreciation will reduce the value of the asset. So 640, you minus. Then additional information number two. Additional information number two. This one is intangible assets. They cannot affect your PPE. Number three, holding company acquired a new plant, which costs 550. So plant acquired at 500. Plant acquired at 500. Then we have the company also revalued its building revalue, or just revaluation on building. So that is 400. So you know that one you add the same way I have added the plant which was acquired. Note 4 was concerning bonus. Bonus can never affect us in PPE. Note 5 was a detailed analysis of retained profits. Again, that one can never affect your property, plant, and equipment. So up to this point, our value for property, plant, and equipment is so this is 39.20. So what about balance carry down of the PPE? The balance carry down. So the property, plant, and equipment balance carry down 37.80. So you can see there's a reduction from 39.20, this one, to 37. So which means that there was a disposal which was done. That is why there's a reduction. There's a disposal of an asset by 140. But once they disposed at 140, they made a loss of 100. That's not only not one, the loss. So what amount did they realize? 40. 40 is what is realized. 40 is what we record here as cash received. Then cash paid was 500. This one you can even pick from here. There's a plant which was acquired. Then after that, I have to check dividends received. Dividend received from. So it can be from an associate or a joint venture, but it will only be dictated by what you have as your investment in non-current assets. So you can say we have investment in associate company. So which means that my dividends received is from associate as dictated by the investment we have. So then we go and do the working for investment in associate. Investment in associate. So doing the investment in associate, we start from balance brought down. We start from balance brought down 160. We add, what we have to add is the share of profit after tax. Share of profit after tax in associate. The share of profit after tax in associate. Remember that if the parent invested in an associate at the start of the year at 160, an amount of 160, he has received an additional income from that associate. He has received an additional income from that associate, from the investment he made in that associate company. So that income he has received is an amount of so group share of profits after tax, group share of associate profit after tax of 40. So which means that its investment has increased from 160 to 200. So, but now the balance carried down was, so the balance carried down is here. The investment in associates, 190, 190, under that non-current assets. So why now you can see that there it's investment. The investment is decreasing from 200 to 190 because this associate paid dividends, but now the parent received. So dividend received. So the parent received these dividends which were paid by the associate. So dividend received from, that is why we say from associate. Dividend received from associate of 10 of 10 of 10. Then there was another intangible asset which was done what? Acquired. So cash paid, that is what I forgot to record up there. But it's okay even if you record at this point. So cash paid to acquire other intangible assets. Cash paid to acquire other intangible assets. So cash paid to acquire the intangible assets. Which other intangible assets am I talking about, students? So the intangible assets I'm talking of is this amount, which is under addition information number 2. Remember, down here, they said other intangible assets acquired during the year amounted to 1,000. So they paid cash. They paid cash of 1,000. They paid cash of 1,000. They paid cash of 1,000. Yeah. So that up to that point, I can say that I'm done with my investing activities. I'm done with my investing activities. So I'm getting a cash outflow of 1450. So that is cash flow from investing activities. Cash flow from investing activities. Cash flow from investing activities. Then we talk about financing activities. We talk about financing activities. We talk about the financing activities. So before I go to the financing, is there any question under investing? So if there's no question, we continue to financing. So the financing activities will be considering the issue of shares, the cash they received through the issue of shares, cash paid on redemption of shares, some borrowings which was done, and say maybe the dividends they paid. So what you consider is you do your interpretation from these points going down. Anything you have not dealt with, anything you have not dealt with from the part of equity going down. Anything you have not dealt with. So let us start with ordinary share capital and share premium. We combine them. We combine them so that after combining the two, we just do the relevant adjustments. So for the combination of ordinary share capital and share premium, what am I checking? I will be checking if there's any issue of shares or a redemption of shares. For reserves, I don't use it. I don't use it in any manner here. For the retained profit, this one will be used to determine dividends paid to the parent, dividends paid by the parent, not to the parent, dividends paid by parent company. For NCI, I will use that one to determine dividends paid to NCI as uongozi, what we paid to the minority shareholders. For debentures, I will check the amount realized on the issue of debentures. For the loans, I would check if there is acquisition of loans or maybe we made a repayment. For deferred tax, we are done with it. That one, we are done with it. For the overdraft, this is a cash and cash equivalent. For the accounts payable, we are done with it. Accrued interest, accrued loan interest, I have to do an analysis to determine interest paid. So for the current tax, I'm done with that. So let us start from ordinary share capital and we combine with the share premium. ordinary share capital and share premium. So the balance brought down 1,000 plus 200. That is for ordinary share capital and share premium. So you get 1,200. Then after that, we check issue of shares through bonus. There was a bonus through bonus. What is a bonus? Shares issued for free to the existing shareholders on a certain proportion. So which proportion did they use when they were making a bonus? And remember that that bonus was financed by the money which was from the revaluation reserve. That is even why I would never use revaluation reserve anyway, because the money which is under the revaluation reserve are the one which have been used in the financing of our bonus. They said that on 1st October 2012, the holding company made a bonus of 1 share for every 10 shares held. The issue was financed from the revaluation reserve. So it's 1 for every 10 shares held as at 1st October 2012. How many shares were held as at 2012? Let us go to our ordinary share capital. So the value given here is 1,000. Per share is shillings 10. Per share is shillings 10. So which means that the shares which were there as at 2012 is 100. Because you take the 1,000, you divide by 10. You divide by 10. So that one goes with that one. So we remain with 100 shares. So we equate with our proportion. 1 for every 10 shares held. What about 100? So we say 100 times 1 over 10. This one goes with this. What is remaining as 10 is what they issued through bonus. The shares they issued through bonus. But I cannot record shares here. I have to multiply with the price of 10. The par value was 10, so that I record 100 in terms of shillings. In terms of shillings. So that here we have 1,300. I compare with what we have as our balance carried down for the ordinary share capital and share premium. So for the ordinary share capital and share premium, our balance carried down is 1,500 plus 700. That is 22. That is 2,200 because it's 15 plus 700. Students, you can see it's 2,200, and that one shows that there's an increase from 13 to 22. That is an extra amount they generated, amounting to what? Amounting to 900. And this one was through issue of shares. You can only generate money here under this account through issue of shares. Through issue of shares. I will come here and say cash received. I will come here and say cash received on issue of shares. On issue of shares, 900. If it was a reduction from 13 to 1,000, the difference of 300 could have been treated as cash paid on the redemption of shares. After we are done with the two items, that is ordinary share capital and share premium, we head to the retained profit. Because already I've said that revaluation reserve, even they told you that the revaluation reserve was the one which was used in the financing of the bonus which they made, because a bonus is shares issued for free to the existing shareholders based on a certain proportion. We go to the retained profit, balance brought down 2760. So retained profit, balance brought down is 2760. What am I computing here to get? Dividends paid by the parent. What you do, you add profit attributable to holding company, profit attributable to parent, stroke holding company, stroke the holding company. So dividends is the one, dividends is what we are looking for. Dividends is what we are looking for. So profit attributable. So the profit attributable to the parent company is from the income statement. You can see 11 and 1160. 1160 students is what is provided there as profit attributable to the parent. So up to that point, the total retained profit so far, so good. It's all about 2760 plus 1160. So that is 3920. That is 3920. Compare with your balance carried down. So the balance carried down for the retained profit. Balance carried down for the retained profit is the retained profit balance carried down. The retained profit balance carried down. That is that is 3140. So the reduction from 3920 to 3140, it means that that reduction is all about the dividends they paid. The dividends they paid of 780. Of 780. So dividends paid. Dividends paid. Dividends paid. So by parent, dividend paid by parent, 780. The next we have to look dividend paid to NCI. You know what's an NCI? Minority shareholders, that is dividends paid to NCI. So we have to do our working. So NCI, you can realize that after retained profit, NCI is next. So balance brought down. Balance brought down is, so we start with the NCI to determine dividends paid to that NCI. So the balance brought down for the NCI, non-controlling interest, that is 200. So after 200, but now there's something I'm seeing here, which I could have adjusted. So sorry for that. Before I go to the NCI, there's a change I am supposed to make. Because under the retained earnings, what I can realize, there's other additional items to be adjusted. So let me make that correction. Because I can see in my last additional information, we had started with this balance brought down 2760, 1160, which is okay. There was this revaluation from the transfer from revaluation. The 20. So the 20 I could have added here. The revaluation. The transfer from revaluation, that is the transfer. So the transfer from revaluation, which means that our retained earnings will be, so 2760 plus 1160 plus 20, that is 3940. So 3940 minus 3140, this is 800. Then there is already somewhere they have said under that liabilities, current liabilities. Have you seen somewhere they said dividends payable? There's somewhere they said dividends payable. So the balance brought down of the dividend payable is the balance brought down of dividends payable. So if I check under that current liabilities, there's this dividends payable, 400 at the start. So which means that it's 400, the dividends they were supposed to pay is 400 plus this 800. For the year is this 800 we have here. So which means that that one is supposed to be 1200. But at the end, balance carried down. The dividends they are supposed to pay, at the end is the dividends they are supposed to pay at the end is 560. So the 560. So which means that dividends paid is 1200 minus 560, which is 640. So these are the dividends I could have recorded here. So 640 is what I will record here, not 780. Then for the NCI, balance brought down, then profit attributable to NCI. So the profit attributable to the NCI. Profit attributable to the NCI is of which value? So you check under income statement, the last item in that income statement, that is 80. 200 plus 80 to 80. 200 plus 80 to 80. Then at the end there is the balances at the end. Balance carried down to 70. The balance carried down, I think you can see it's 270. Then what you will do a conversion. So the balancing figure would be the balancing figure there is
Where are you getting the 200?
200
The
is
280.
So I'm taking a balance brought down of NCI. So the balance brought down of NCI is, so that is why I was asking, so that I check. Are you seeing what I'm doing? So the balance brought down of the NCI is, are you seeing under the equities and liabilities? The one who asked the question, are you seeing that figure under the equities and liabilities? It's a yes or no?
I'm not seeing NCI under equity and liabilities.
Non-controlling interest. There's no non-controlling interest. You are not seeing non-controlling interest.
Oh, I've seen it. Okay.
The balance brought down there is 200.
Yes.
Yes, so that is what I'm talking about. So if you take your 200, you add that profit attributable to the NCI. Profit attributable to the NCI of 80. Are you seeing the 80?
Yes.
Yes, so you are seeing the 80, that is fine. So at the end, the NCI is, now you come back to your statement of financial position. You are seeing the 270 now.
Yes.
this one. So there's a reduction of, it's 10. So 10. So it's that is a balance carry down. Balance carry down is 270. So it's a reduction of 10. Dividends. Dividend paid. So that is dividends paid of 10. So dividend paid to NCI, so 10. So then the next thing we go to is liabilities. We check liabilities. So after we are done with the dividends paid to the NCI, we move on to the liabilities. So the liabilities, there's this 10% debenture. So at the start, it was 200, at the end is 600. So there's a cash realized on issue of a debenture of 400. This cash realized there, 600 minus 200 from the debenture. So that is money in. What about loan? Did they pay the loan? Or they went ahead again to acquire more loans? So it was 600 to 520. It was 2012, 2013. So they made a repayment of 80. Loan repayment. So we have 600 minus 520. So that is 80. Loan repayment. They made a loan repayment. Then after that, so we are done with the debentures, bank loan. The last thing we have to do here is to determine interest paid under current liabilities. You can see that there is accrued interest. So accrued interest at the start is, so the interest they were supposed to pay is 10. You add with your finance cost. Finance cost is all about, again, interest items they were supposed to pay. So finance cost is from the income statement, the 60. So if you check your 10 plus 60, 10 plus 60, you get what? 70. 10 plus 60 is 70. But you can see at the end, they're supposed to pay an interest of, am I doing the correct thing? This is the figures I've picked. Yes, I'm okay. So it's a 10 plus 60. At the end is 30. So which interest has been paid already? Because they were supposed to pay 60. 10 plus, they were supposed to pay 70. 10 plus 60. But now at the end, they are supposed to pay what? 30. So the interest paid already is?
40.
40. So interest paid is 40. So 10 plus 60 minus 40. But no, 10 plus 60 minus 30. So which means that 40 has already been paid. So up to that point, $900 minus 640 minus 10 plus 400 minus 80 minus 40. Give me the answers. Give me the answers at least, so that I know you are here. You are participating. You are getting what I'm doing. Which answers are you getting there? Answers coming in. So Gideon is getting 530. 530. So here we have 530. So on the last column, so that is okay. It's 530. So we have a cash flow from investing activities, from financing activities. from the financing activities. From the financing activities. So the answer from operating was, you add with the one from operating was 1290, the one we did here. So take 1290. So to get net cash flow, to get the net cash flow, we have 1290 minus 1450 plus 530. So that is 370 students. Then we add cash and cash equivalent brought down. So cash and cash equivalent brought down so that we have a cash and a cash equivalent, cash and cash equivalent carried down. So the balance carried down. So who can mention some of the cash and cash equivalent items? Who can mention the cash and cash equivalent items? You know. Which are some of the cash and cash equivalent items you know? Quinta, which are some of the cash and cash equivalent items? So the cash and cash equivalent items include cash in hand, cash at bank, bank overdraft, and a short-term investment. So we do a working, a small working here for cash and the cash equivalent. So the cash and cash equivalent. So remember that we have 2013, these are working, and we have 2012. So which are some of the cash and cash equivalent items we have from our question? Which are some of the cash and cash equivalent items we have? So the cash and cash equivalent items we have is under the current assets. Under the current assets, we have the cash. We have the cash. So 140 dash. We have the cash. So if there was bank balance, you add. That is another cash and cash equivalent item. If there was short-term investment, so short-term investments, e.g. financial assets, at fair value. So the financial asset at fair value. So if there is that one, you add. Then finally we raise bank overdraft. We raise the bank overdraft. So for the bank overdraft, I think it was there under the current liabilities. So the bank overdraft is, you can see it's dash and 230. Dash 230. Dash for the first year, 230 for the final year there. For the first year, 2012, that is 230. For 2013, it's dash. So this one is 230, and this is 140. So this is my balance brought down, cash and cash equivalent brought down, and this is cash and cash equivalent carried down. So if you go and put your 30, that is 230 here, you sum with what you have as your net cash flow. You are supposed to get 140, this one. You are supposed to get that if you have done your statement correctly. So let's take 370 minus 230. So you can see I'm getting 140. I'm getting 140, the one we have here. So the cash flow statement you can mark for yourself. So that is how you are supposed to do the equation using the indirect method. I would like to do the same question using the direct method, but now the only part is operating activities, which will be a bit different from what you know. Because now investing and financing are the same in both methods. So the next thing I have to do now is using the direct method. And the only part I will do is operating activities. For the other two parts, that is investing and financing, they are the same from what we have done using the indirect method. So uongozi, limited, we have the consolidated, consolidated cash flow statement. So for the year, ended, that is our financial year was ending when? Back in September 2013. So we start from operating activities. We have cash received from customers. Cash paid to suppliers. And we have cash paid to employees. So you get cash generated. Cash generated from operations. So that we less tax paid. After tax paid, we get the cash flow from operating activities. So we start from cash received from customers. We do debtors account. We will do the debtors account. So the balance brought down and the balance carried down. So that is trade receivables account. So for the trade receivables, the balance brought down is 1360. At the end is 1980. So 1360. At the end is 1980. So brought down, it means that the one for 2012, the one which was opening the year 2013. So what can increase your debtors account? Sales, which we made. We assume that the sales was on credit. The sales made was on credit. So this sales was on credit. We assume that sales on credit. So that is what can increase your debtors balances. So 7640, you debit. So that the balancing figure is cash received. Cash received. 1360 plus 7640. This is 9,000 minus 1980. So that is 7020. 7020 is what you have here. Then cash paid to suppliers. So these are about to customers. Cash received from customers. Cash received from customers. That is what you do. You do debtors account. Then cash paid to suppliers. Cash paid to suppliers. Suppliers. So what you do first is all about you determine credit purchases by saying that cost of sales. By saying that cost of sales is equal to opening stock plus purchases minus closing stock. Minus closing stock. We need purchases. We need purchases. So purchases is equals to cost of sales minus opening stock plus closing stock. So what is the cost of sales here? $52.40. Are you seeing the $52.40? It's under the income statement. Under International Accounting Standards 1, we always say that expenses are classified under functional heads. These functional heads being cost of sales, administrative cost, distribution cost, and finance cost. Whereby you will find that expenses like depreciation and loss on disposal are under the cost of sales. So we have to deduct them here. Depreciation was 640 and loss on disposal was 100. These two are included under the cost of sales. Depreciation and loss on disposal. We minus our opening stock. We add our closing stock. Opening stock is the stock for 2012 and the closing is the stock of 2013. So opening stock, inventory as at 2012, 1880. Then the other one is 2840. Inventory as at 2013, 2840. So what are you getting here? So we have 5460. So we start from the balance brought down, balance carried down beside. So balance brought down of payables. So the balance brought down for payables, you go to your current liabilities, 2012, 1460. 1460, then we have 1750. 1760 for 2013. So brought down, carried down. Then what can increase this account is the credit purchase we have determined. Credit purchases. So 5460. So what can reduce this account? Discount received, but there's none. So the balancing figure is what you paid to your suppliers. So 6920 minus 1750. So you have 5170. Cash paid to suppliers. So I have said here we add credit purchases. What can reduce what you are supposed to pay to your suppliers if you are given discount? It's the same way under debtors, I could have said, what can reduce your debtors balances? Bad debt written off. But this one was not there. Or even discount allowed. Discount allowed. Then finally, we have to check for the cash paid to employees. For the cash paid to employees. For the cash paid to employees, I said that we consider the operating expenses, that is admin and the distribution expenses. Admin and distribution expenses. So cash paid to employees. So cash paid to employees, that is we consider admin. So if you are paying your salaries to, let's say, the staff, those expenses are included on admin. You are paying, for example, your directors and so on. That is why we are considering administrative. And for distribution, let's say you are paying your sales agents, commission, and some salaries. Those expenses, obvious, according to S1, they are classified under distribution. That is why I am considering them. So they never said admin or distribution, but they gave us a block figure called operating activities, 600. So both of these are operating, 600. Then the only adjustments I will make, which has not been made anywhere. Remember right now when I was doing my credit purchase, under the cost of sales, I deducted what? Loss on disposal, and the depreciation. And the depreciation. Which adjustment is remaining to be adjusted there? The one which was not adjusted, the one which is not in the balance sheet. the one which is not in the balance sheet. So checking from my other method, remember that I've adjusted this under the cost of sales and loss on disposal has been adjusted. So the only thing remaining here is these two. This one have not been adjusted anyway when doing my direct method. Because already if it's finance cost, this one was adjusted already in the income statement. It was in the income statement. So which means that I have to raise amortization and impairment. Impairment. And amortization of 60. So which means that that is 300. So 70, 20 minus 51, 70 minus 300. So this one was 1550. Our tax we did initially was from the previous method. I don't want to repeat myself. So the tax we did, we got what? This is the working I did. Tax, we considered both current and deferred. By taking the two, we added the income tax from the income statement, then we compared with the tax they are supposed to pay at the end. So we found that they have already paid a tax of 260. So that is the same way you do that working here again, but already we did that. So that is 260. So 1550 minus 260, 1290. So that is my A. So if you could have continued with B and C, which is investing and financing, investing and financing activities. Investing and financing activities, they are supposed to be the same as that one of indirect method. So you can check when we did using indirect method, our operating is 1290. The same way we have arrived at 1290 here using this method. And that marks the end of this question using both the direct and indirect methods. So since we are done with the question of that May 2014, I would like to interpret this question of November 2018 so that you can do it as part of your assignments. So they were saying that the following financial statements relate to SASMUA and its investment companies for the year ended 30 September 2018. We have the consolidated statement of comprehensive income for the year ended 30 September 2018. So we have that income statement there. So which means that 30 September 2018 is our current year. So which means that it started on 1st. It was starting on 1st what? 1st October 2017. So which means that in the statement of financial position, you will be given another statement for 2018 and 2017, which starts on 1st October 2016. But you will be given balances as at this date. So which means that my balances as at this date would be opening here. So these balances from previous year is what I would be calling balances brought down here and carried down there. The one which are given for 2018, you would be calling them carried down, balance carried down. That is what has been provided in this question. For the consolidated statement of changes in equity, this one, there's no way you will use it. Put a big X under the statement of changes in equity. Hiyo isikupatie stress, uachane nayo, hakuna mahali utaitumia. So what I wanted to interpret is additional information number 1. So in scenarios, you see that you are given PPE, but they have interpreted this way, whereby they have given you the cost and the accumulated depreciation, but you are not given the depreciation for the year. Ukiona umepewa hivyo sasa, jua ya kwamba unafanya T accounts to get depreciation for the year. Remember that the question we did was the depreciation was given direct. So then checking on the next information here, during the year ended 30th September 2018, an 80% owned subsidiary revalued its property. That one, it doesn't have any issue because you know that is revaluation of 150. The holding company disposed of an item of land which had costs 290 and had accumulated depreciation of 96. The disposal proceeds amounted to 215. So remember that you have to do a disposal account to determine gain or loss due to that information given here. The holding company disposed an item of land. So we have to do disposal account. Then number 2, the 10% convertible loan stock was convertible at any time at the holder's option into 20 ordinary shares of shillings 10 each for every 200 of the loan stock. During the year ended 30 September 2018, holders of 180 million of 10% convertible loan stock exercised their conversion option. So we need to check how did they convert this loan stock to shares. Impairment loss on goodwill and depreciation have been charged to profit or loss. Assume corporation tax rate of 30%. So let me do for you the first working and the second working. How to determine depreciation for the year when you are given accumulated depreciation. You do a depreciation account. You do a depreciation account. So depreciation account goes hand in hand with disposal account. Goes hand in hand with disposal account, of which again I have to do PP analysis. So these 3 are done concurrently. They are done concurrently. So for the disposal account, you know that you debit costs, you minus accumulated depreciation, and the sales proceeds. So of which, if you get a loss or a gain, it's okay. That is what we are looking for. So the cost of the asset which was disposed. So they say that the holding company disposed of an item. You can see where my cursor is. The holding company disposed an item of land which had a cost of 290. It was having a cost of 290, accumulated depreciation of 96. And we have sales proceeds. The disposal proceeds amounted to 215. 215. Amounted to 215. So the balancing figure there is 96 plus 215, that is 311, which means that there is a gain. There is a gain on disposal here. If it's a loss, you could have recorded here. But now, since the balancing figure is on the debits, it's a gain of 21. Gain on disposal. Part of the adjustments done in the operating activities. Then for the PPE balance brought down, because this one we do direct. Then for the depreciation, balance brought down here, then balance carried down here. So for the depreciation account, the accumulated depreciation as at 2017, the end of 2017, which would be the opening of the year, 1st October 2017, ending 30th September 2018, is 625. 625 is the brought down there, and the 934. 934 is the balance carried down here. Then there's this accumulated depreciation on disposal. So it is credited here, we debit here. Of which I don't think if there's another asset which was disposed other than the one we have. So which means that my depreciation for the year is 934 plus 96, 934 plus 934 plus 96. My debit side will be 1030 minus 625. So depreciation for the year, the balancing figure. So in order to get the entirety here is 405. So that is the depreciation for the year, to be adjusted in operating activities. Then you know that gain, again, is another thing we were looking for, and we have again this. So those are the two adjustments you already have. Then now to do your PPE analysis, you start from balance brought down of the PPE, the balance brought down of the PPE, the balance brought down of the PPE, which is, I can say, using the cost approach. So 2970, so I can use 2970 cost approach. Then I will add a revaluation of 150, because there's that during the year ended 30 September 2018, and 80% owned subsidiary was revalued. So revaluation, so 150. And there was a disposal. The cost of this asset which was disposed is 290. Then after that, note 2 was all about loan stock. Note 3 is impairment. Note 4 is corporation tax. So the only thing I have to raise here again is the depreciation which we have determined. Depreciation of 405. Because it would have to reduce the value of the asset. So 2970 plus 150 minus 290 minus 405. So this is 2425. So the balance carried down here is 3765. So 3765 minus 24. As we continue, we had already used the cost approach in this analysis of PPE, of which I started with the balance brought down of 2970. I added the revaluation, which is okay, the disposal. So this already, the depreciation has already been adjusted. We don't have to record again this one. So that is the only mistake I was doing there. That is the only mistake I did there. So 2970 plus 150 minus 290. So that is 2830. So that it increased to 3765. So increasing, it means that they have done what? An acquisition. So 935 would be cash paid to do what? Cash paid to acquire. Cash paid to acquire fixed assets. So cash paid to acquire an asset. So this one goes to investing. This one goes to investing. You are 405, you are just under operating activities. And you are 21, again, you are just under the operating activities. So to do the next additional information number 2. Additional information number 2, they were saying that the 10% convertible loan stock was convertible at any time at the holders option into 20 ordinary shares, of shillings 10 each for every 200 of the loan stock. For every 200 of the loan stock. During the year ended 30 September 2018, holders of 180 million of the 10% loan stock exercised their conversion option. So this one means that there was a loan stock which is going to be converted into ordinary shares, of which 20 ordinary shares of 10 each for every 200 of the loan stock. So they are converting in this proportion, 20 ordinary for every 200 of the loan stock. So, but they went ahead to say who exercised 180 of the loan stock. During the year 30 September 2018, holders of 180 of the 10% loan stock exercised their conversion option, which means that they converted to ordinary. So what about 180? So we are in need of how many shares they converted to. So you cross multiply, you get how many shares? 180 times 20 divided by 200. You get 18, eh? You get 18. So per share was at what value? Per ordinary share was at what shilling? The 20 ordinary shares were trading at. So 20 ordinary shares of shillings 10 each for every 200 of the loan stock. What about 180? We have found that out of the 180 of the loan stock, which was exercised to ordinary shares, they converted that to 18 shares, but per share was shillings 10. So to get the value, I have to multiply with 10 to get 180. Where will this one affect? Where would this be taken to? So this one will be taken to ordinary share capital when I will be doing my ordinary share capital and share premium analysis. So the balance brought down. The balance brought down for the ordinary share capital and share premium. The balance brought down for the ordinary share capital and share premium. So that is 1,400. 1,000 plus 400, that is 1,400. The ordinary share capital and share premium. 1,400, that is 1,400. Then the conversion of bond now to shares. Remember that conversion of that loan stock. It was a loan stock which was converted to 180. The shares which are worth 180. The shares were 18, but to get the value, we have to multiply with 10. So that one will increase this one to 1580. Then I will compare this account with the balance carried down. So balance carried down of ordinary share capital and share premium is, so the ordinary share capital and share premium, 1320 and 460. 1320 plus 460. 1320 plus 460. That is 1780. So there's an increase of cash from 1580 to 1780. So there's an amount of 200 which was received, and this one was through issue of shares. Issue of shares. That is why they received the 200, the extra 200. So you go to the financing. When I will be doing my financing activities, I will say cash received on issue of shares, 200. Cash received on issue of shares, 200. I think there's nothing I have not interpreted yet. For the others, it's just direct, the one you know from. The others, you know how to do them from the statement of a financial position and income statement. Is that through? So now you can go and do that question. Delvin?
Yes.
Leah?
Yes.
So you can try and do. So these were the only challenging areas, that working 1 and 2. The additional information number 1 and 2. So, but now you have seen on how you are supposed to get your depreciation for the year when you are given that aspect of accumulated depreciation, of which you have to prepare a depreciation account and at the same time disposal account to get gain or loss on disposal. So when you are preparing this account, you will find that obvious. You are told there was an asset that was disposed. You have to do disposal account, then you do a PP analysis. You either get acquisition or disposal of an asset. Then for the other loan stock was through conversion, and there was a loan stock which was converted to ordinary. So once they are converted to ordinary, remember that our ordinary share capital account must increase. So you have to determine the way they converted, then you increase your ordinary share capital account so that you do your analysis of the capital account. You determine either if there is issue of shares or the redemption of shares. So you can have a nice time in this revision period as we add to the exams. And if you do your revision well, everything will be okay at the end. So you can have a nice day. We meet in our next class when I will be doing branch accounting. And at the same time, I request that be reading financial analysis, because financial analysis, what is there? It's only that you need to understand on how you analyze income statement, statement of financial position using the common size method. Common size method, it has 2 methods to be used, the vertical and the horizontal. So you need to understand on how you are supposed to use the vertical method to analyze income statement. You are supposed to know how to use horizontal method to analyze the statement of, both statements. So income statement, statement of financial position. You need to understand on how to use a vertical method to analyze that and the horizontal method to analyze that. Then ratios. Ratios is all about formulas. Even if I teach you here, yes, of which I will do, you need to know the formulas. You know, once you get the formulas into your mind, ratios is the same thing you do in financial management if you are a student of FM. Then for the local independent branches, that is the one I have to do it to interpret some few things. Nice time. Nice revision.